The Fed may only be halfway through its 2019 round of cuts. JPM Asset Management is predicting 2 more. Bob Michael is the head of global fixed income at the firm. Welcome to you, Bob. Good to see you again. So this, according to what the Fed said, it sounded like it would probably be 1 more rate cut this year, but you're actually thinking more. What prompts them to do more? Eventually?
Well, I think there are a couple things. One, they didn't close the door to anything. They've been cutting rates twice. The economy looks okay optically, but they've always talked about the spillover from the trade war, maybe from manufacturing into services. We haven't seen any reversal of anything on the trade front. If anything, you're seeing an escalation starting to pass through. So we think they're going to have to come back in October and in December and cut rates another 25 basis points each time.
Each time. So do you think that we're headed for a recession at this point, even though the Fed was pretty measured and pretty actually rosy about their outlook for the economy?
Well, the yield curve's inverted, which tells you that they're following the curve. And when you listen to the Fed and Powell and they talk about their data dependent, sure, we can look at the data. It tells us what happened last month, last quarter. It doesn't tell you where we're headed over the next quarter and the next year. And I think until you see something on the fiscal side, either some form of stimulus or you see a rollback on the tariffs and some de-escalation of trade, we're definitely on this road to recession.
And Bob, you're dead right. And if you look at the trend going over 4 decades, it's working towards your trade here. But if I listen to the Fed today, the one thing that did sound relatively dovish was that he refers to the 12-month rate of inflation. And the Fed obviously is at times leaned on inflation to push their dovish argument, when in fact the last 4 months on inflation have been quite hot. So do you think inflation is this place for the Fed to hide out and actually give more easing than the market even expects?
I think it's a mistake. I think there's a one-time surge here from energy prices. But if you look at core inflation and you look at the trend, it's definitely coming down. I don't think that the threat of an inflation surge is their concern. That shouldn't be holding them off on cutting rates. Their concern should be a recession could be coming fast unless something happens on the fiscal side.
So Bob, I know you're a fixed income guy, and I've been trying to make some bear case in equities for a while now. It doesn't seem to work. And then we talked about FedEx, U.S. Steel, all the things going on. At what point from where you are, 30,000 feet, does this affect the equity market?
Well, we see it in credit, right? Because by our calculation, credit spreads look pretty good. They're near their tights. So bond yields have fallen across the board, particularly government bond yields, and everyone wants to say that's because the market thinks recession is around the corner, yet you're not seeing it in credit spreads. And that's telling you that until you see recession and until earnings start to go down, until you start to see dividend cuts and default rates go up, people are going to scramble to pick up yield, and greed will replace fear. And I think that's what we're seeing currently.
All right. Bob, great to see you. Thank you so much for your time. Bob Michael, JPM. Okay.
Well, I think it's interesting because Bob got a front row seat to this, right? And so we had somebody on saying the bond bubble has burst, and Bob is saying, hey, wait a second, we're not necessarily seeing that. The things you have to look for are what Bob said was the fiscal stimulus. Coming into an election year, is there going to be fiscal stimulus? To me, that's kind of the game-changing element in this here. But in the meantime, you can still have a stock market that rallies to new highs, and people get it wrong. People get Q4 earnings wrong, that they're going to be, people think, oh, they'll dismiss them. You can get, and that would be very typical of a late cycle blow off top. That wouldn't surprise me whatsoever.
So, and we also often say on this show that the bond market is always smarter, and certainly the credit markets are the greatest read. And Guy asked the impact on what do you think this all means for equities. So when I look at the S&P dividend yield minus the triple B credit spread, it's at wides of 60 years. We haven't been this wide in a long time. That is very, very equity positive. So in other words, it's telling you a tale of where rates are much lower and earnings yields are much higher. You should go buy equities.
So the other reach for yield has been in the chemical space, in the packaging space, where everyone has thrown those out. But names that have done well and sectors that have done well are your utilities. They're up over 20% year to date. They continuously perform, and staples. And everyone's talking about valuation. No one cares about valuation when you're hunting for yield. No one cares about valuation when you're looking for defense. And both of those things have proven that.